All right, everyone, buckle up for another deep dive. Today, we're really dissecting the cryptocurrency market, specifically asking if that, long-awaited altcoin season is finally here. And crucially, what that means for giants like Ethereum. It's a question buzzing across the entire crypto community, right? So we're here to unpack it.
Indeed. And this deep dive, it's going to synthesize some really crucial insights from major players and data sources. We're talking about research straight from Coinbase, market commentary via Cointelegraph, and of course, analytical data from TradingView. Our mission isn't just to tell you what might be happening,
Right.
but to really dig into the why.
Yeah.
Why these significant market shifts might be occurring, hopefully giving you a clearer lens to navigate these pretty dynamic waters.
That's exactly it. We've pulled together some truly fascinating perspectives, and they paint a compelling, although, let's be honest, complex picture. We'll be exploring everything from these huge macroeconomic forces, think trillions potentially coming into play, to specific on-chain indicators telling us, exactly where we stand today. And maybe most importantly, we'll examine some vital cautionary tales. We need that well-rounded perspective on what could be ahead in the altcoin world. This isn't just about crystal ball gazing, it's about understanding those underlying currents that are likely going to shape the next phase of this market. Defining and detecting the altcoin season. Okay, so if we're trying to dissect the crypto landscape for clear signs of a real altcoin surge, where do we even begin? It's interesting, actually, because one of the boldest and maybe most precise predictions, it's coming directly from a major player.
Yeah, Coinbase, right?
Exactly. Coinbase's global head of research, David Duong, he isn't just making a casual forecast. He's formally calling for a full-scale altcoin season. And according to his projections, his analysis, it could kick off as early as this September.
Wow, September. That's soon.
It is. That's a strong, very specific statement from, a highly reputable source. It definitely signals a potentially significant shift maybe just around the corner.
And what's truly fascinating here, what I think sets Coinbase's analysis apart, is their very precise, data-driven definition of an altcoin season.
Right. It's not just a feeling.
Exactly. It's not just a vague notion or, seeing a few random altcoins pump. They define it as a specific measurable event. It happens when at least 75% of the top 50 altcoins by market cap
Top 50, okay.
manage to outperform Bitcoin. And that's measured over a rolling 90-day period.
20 days. So it needs sustained outperformance across the board, essentially.
Precisely. And this level of specificity is absolutely crucial. It moves us beyond just, speculation. It gives us a concrete, quantifiable benchmark. It suggests, I think, a growing maturity in market analysis. The industry is increasingly looking for tangible, quantitative proof of a broad market shift.
Yeah, not just hype.
Not just hype, not just isolated rallies. The implication of hitting that 75% threshold is pretty profound. It would signify a deep, broad capital rotation, widespread confidence across a whole diverse range of alternative cryptocurrencies. It's not about picking one or two winners. It's about systemic, market-wide outperformance against Bitcoin itself. And such a clear signal, it's invaluable for institutional investors, for sophisticated traders who rely on these metrics for their strategies. It points towards a more, let's say, reliable market phase, albeit still volatile, of course.
Okay, so given that very stringent data-backed definition from Coinbase, 75% of the top 50 over 90 days. Where are we right now? Is the market showing those early signs, or are we still, just in the pregame warm-up? The Altcoin Season Index, which aggregates data from CoinMarketCap and tracks this very metric, is currently sitting, I checked earlier, in the low 40s.
Low 40s.
Yeah. So clearly not the 75% threshold Coinbase is talking about for that full-scale season. It tells us, okay, we're not quite there yet by that strict definition, but...
But that but is absolutely key here. You're right. While 75% might seem a long way off from the low 40s, it's critical to note that the index is climbing and climbing fast. Just because we haven't hit that full-scale mark doesn't mean nothing significant is happening sort of beneath the surface. If we connect this to the broader market context, we've also seen the total altcoin market capitalization jump by over 50% since early July.
50%, wow.
Yeah, over 50%. That's not just a minor blip. It indicates substantial, sustained momentum, a clear, meaningful inflow of capital into the broader altcoin market. Think of it like a dam slowly filling up. The water level is consistently rising. You can sense the pressure building.
Okay, I like that analogy.
Well, we haven't reached the point where it overflows into that full-scale torrent of altcoin activity. This 50% cap increase combined with a rapidly climbing index, it strongly points towards a building crescendo. It's not an immediate explosion, maybe, but it's a strong, sustained movement of capital into the space. It's meticulously setting the stage for what could very well become a much larger, more comprehensive market event later on. This trend suggests investors are getting more comfortable deploying capital into alts, expanding beyond just Bitcoin and actively looking for those higher risk-adjusted returns. They're recognizing the potential there. 2. The macroeconomic forces fueling the altcoin momentum.
And this is where it gets truly captivating for me, because these internal crypto market movements, they don't happen in a vacuum, do they? They're often profoundly influenced by these massive macroeconomic forces swirling around. I mean, consider this figure. It's staggering. A near record $7 trillion in U.S. money market funds are currently just sitting on the sidelines, basically idle.
$7 trillion.
Yeah.
It's almost hard to comprehend that amount of capital.
Right. Just parked in low-yield accounts, waiting.
And this raises that incredibly important question. Okay, how does this colossal sum, seemingly far removed from the volatile world of, say, Pepe coin,
Yeah.
how does it connect to altcoins?
Yeah. What's the link?
The profound connection lies in the potential shift in global monetary policy, specifically the Federal Reserve, with potential interest rate cuts looming on the horizon. And that prospect has gained significant traction in recent economic forecasts.
We keep hearing about it.
Exactly. The already low yields on these traditional low-risk money market funds, they're likely to diminish even further. So when that happens, this massive pool of cash, retail, institutional, all of it currently seeking safety, it can very quickly start looking for higher yielding alternatives.
Ah, so chasing yield.
Precisely. It presents a powerful macro tailwind for riskier assets across the board, including, and perhaps especially, for altcoins. We're not talking about a trickle here. $7 trillion. That's a potential tsunami of capital. Think about it. If even a small, really conservative percentage of that, say just 1% or maybe 2%, were to migrate into the crypto market,
That would be huge.
it would inject hundreds of billions of dollars. To put that in perspective, the entire altcoin market cap right now is less than $1 trillion. Such an inflow could profoundly impact valuations, particularly in the more agile, higher beta altcoin sector. Investors are effectively incentivized, you could almost say forced, out of those comfortable low-yield positions into assets promising better returns, even if they come with higher volatility.
So it's classic capital allocation responding to interest rates, but on a crypto scale.
Exactly. It's a fundamental principle of finance, playing out now on the cryptocurrency stage with potentially explosive consequences. Historically, when safe havens offer less, capital gets more aggressive, it seeks growth. And crypto is increasingly seen as a viable, though still speculative, growth sector.
Okay, that makes a lot of sense. Now, another critical indicator, one that, seasoned crypto watchers always keep an eye on, is Bitcoin's dominance. And we've seen a pretty notable decline there. It's dropped from roughly 65% of the total crypto market cap back in May down to about 59% in August. That's not just a number changing. It feels like a telling sign of shifting dynamics.
It absolutely is. This declining Bitcoin dominance, it's a classic signal. Historically, it's been a reliable indicator of capital rotation. We've seen this pattern across multiple market cycles.
Right. After Bitcoin runs, people take profits and look elsewhere.
That's generally the pattern. After Bitcoin has its major price runs, maybe hits new highs, investors often take some profits off the table from those significant Bitcoin gains. And then they look to redeploy that capital into altcoins. The motivation is pretty clear. Altcoins, generally speaking, have smaller market caps.
So more room for percentage gains?
Exactly. More potential for higher percentage gains compared to Bitcoin, which, just due to its sheer size and liquidity, tends to move a bit more slowly on a percentage basis. Now, this isn't a sign of weakness for Bitcoin itself. Not at all. Rather, it demonstrates growing confidence in the broader crypto market beyond just Bitcoin. It suggests investors feel comfortable enough to diversify, to seek what they perceive as higher growth opportunities within the altcoin space. It indicates a broadening of investment interest.
And you think this time is different somehow?
Well, what's particularly striking this cycle isn't just the rotation itself, but maybe the type of capital rotating. We seem to be seeing less of the purely retail-driven, maybe speculative pump-and-dump behavior of the past, and perhaps more systematic rebalancing. That suggests a deeper, potentially more sustainable reallocation of funds. It implies the market is maturing somewhat. Participants are becoming more sophisticated in their asset allocation, actively seeking performance beyond just the main event, Bitcoin. It's a clear sign that capital is beginning to flow downstream, out of the largest asset, into the myriad of other digital assets. It's a widening of the investment aperture across the ecosystem. 3. Ethereum's central role in the altcoin narrative.
Now, it seems like the whole narrative for this potential altcoin season hinges quite significantly on one particular asset, Ethereum. It almost feels like the entire market is sort of holding its breath, waiting for Ethereum to make its big, definitive move. There's even this specific, pretty ambitious target floating around Ether reaching $6,000. That would be a substantial jump from where we are now. So why is Ethereum so central to this whole altcoin surge idea? What's driving that kind of optimism?
Yeah, that $6,000 target, it's ambitious. But the upward momentum for Ethereum isn't just based on speculative hope or sentiment. It's really being driven by concrete, fundamental factors, most notably a significant and increasing institutional interest.
Ah, the institutions again.
Yes, we are witnessing what analysts are calling digital asset treasury accumulation. This means institutions ranging from corporate treasuries of public companies to large VCs, even traditional asset managers. They are strategically actively adding ETH to their balance sheets.
So not just trading it, but holding it long term.
Exactly. This isn't short-term trading for quick profits. It appears to be a strategic long-term hold, indicating a much deeper conviction in Ethereum's underlying value proposition as a foundational technology. This institutional adoption provides a really robust foundation, a level of legitimacy that feels quite different from prior bull cycles.
How so?
Well, in the past, a lot of the market's big moves were predominantly driven by retail speculation, right? Which often led to more volatile, less sustainable, sometimes shorter-lived rallies.
The boom and bust cycles.
Kind of. Now, with institutions getting involved, they're larger capital pools, they're typically longer investment horizons, they're focused on fundamental utility. It contributes to potentially greater market stability and the possibility of more sustained growth. It signals that Ethereum is increasingly being recognized as a legitimate, investable asset class within traditional finance. It's moving far beyond its early, more experimental phase. This validates Ethereum's position as, really, a cornerstone of the digital economy. It attracts serious capital, builds a more resilient market structure, and that directly fuels the price appreciation of ETH.
Okay, so the institutional buy-in is massive. But beyond just that, which is clearly a huge driver, we're also seeing just undeniable, rapidly increasing adoption across Ethereum's incredibly vast and diverse ecosystem, aren't we? This isn't only about the price of ETH as a speculative coin, it's profoundly about the expanding utility of the Ethereum platform itself. We see this everywhere. In decentralized finance, DeFi, the huge stablecoin market, even this exciting new frontier of real-world assets being tokenized and managed on the blockchain.
Absolutely. And if we connect that to the bigger picture, the growing utility of Ethereum as the premier platform for all these diverse, innovative applications, it directly drives sustained demand for ETH, its native currency.
How does that mechanism work exactly?
Well, think about the mechanics. Every new user who engages with a DeFi protocol, say AAA for lending or Uniswap for swapping tokens, every new project that chooses to launch and build on Ethereum, every single stablecoin transaction, whether it's USDC or USDT, that uses the Ethereum network, or every real-world asset, like a digital bond or tokenized real estate, that gets managed on the blockchain. Each of these actions adds to what we call the network effect.
Right. The more people use it, the more valuable it becomes.
Precisely. It's this powerful feedback loop. The more useful the platform becomes, the more people use it, which in turn makes it even more useful and valuable. And this isn't just about speculative price action. It creates fundamental organic demand for ETH. Every interaction generally requires ETH for gas fees to execute transactions, or ETH might be needed for staking to secure the network, or used as collateral in various financial protocols.
So it underpins the whole system.
It really does. It solidifies Ethereum's position as the foundational cornerstone of this decentralized economy. For example, you look at the total value locked, TVL, in DeFi protocols on Ethereum, the sheer volume of stablecoin transfers, the increasing number of enterprises exploring RWA tokenization. All these contribute directly to ETH demand. This utility-driven demand provides a powerful, inherently sustainable fuel for its value proposition. It makes it far more resilient, arguably, than assets driven purely by speculative hype. It ensures that the growth and expansion of the Ethereum ecosystem translate directly and meaningfully into the value of ETH, making it absolutely critical in any potential altcoin surge. 4. Navigating the risks. Lessons from recent case studies.
Okay, well, the upside potential in an altcoin season, especially one potentially driven by these powerful macro forces and Ethereum's own growth, it's incredibly exciting, no doubt about it. But It is absolutely crucial that we acknowledge and really try to understand the inherent risks involved.
Yes, so
And we actually have a compelling case study that brings this home pretty vividly. It involves a company called SharpLink Gaming. They actually hold a substantial amount of ETH. They're quite significant players, holding roughly 728,804 ETH. At its peak, that was valued at about $3.5 billion, which apparently makes them second only to Bitmine in terms of reported Ether reserves.
that's a huge position, a major commitment.
It really is a huge strategic commitment to the Ethereum ecosystem.
And this SharpLink case, it raises an incredibly important question, especially for listeners maybe looking at more sophisticated DeFi strategies themselves. Even with such significant holdings, even with that seemingly strategic positioning, SharpLink posted a substantial $103 million paper loss in Q2.
Ouch. $103 million paper loss.
Yeah. And this wasn't just, the market dipping. It was specifically attributed to liquid staking impairment.
Liquid staking impairment. Okay, can you unpack that a bit? What does that mean?
Sure. So this case really highlights the inherent, often complex risks within these altcoin-linked treasuries, especially when companies or even individuals engage with more nuanced, more innovative DeFi strategies like liquid staking. Now, liquid staking, it offers attractive flexibility, potential yield, right?
Yeah.
Stake your ETH, you get a liquid staking derivative token like Steth from Lido, for example, in return, which you can then use elsewhere in DeFi.
Right, so you get yield and liquidity.
That's the idea. But it introduces additional layers of risk beyond just holding your spot ETH. This impairment that SharpLink experienced often stems from the depegging risk of these liquid staking derivative tokens relative to the underlying ETH.
Meaning the token isn't worth the same as the ETH it represents.
Exactly. When market conditions create a liquidity crunch, or maybe if there's a sudden loss of confidence in the underlying staking protocol or its specific liquid token, these derivatives can start trading below parity with ETH. They might trade at, say, 0.98 or 0.95 on the dollar compared to ETH. So for a large holder like SharpLink, even if their underlying ETH is still safely staked and earning rewards, the market value of their liquid staking tokens can decline significantly on paper. That causes this notional or paper loss.
I see. So it's not that the ETH is gone, but the token representing it is worth less temporarily.
Correct. And there are other risks too, like potential smart contract vulnerabilities within the staking protocol itself, or the risk of slashing penalties if the validator securing the network misbehaved. And of course, just general market volatility impacting both the underlying ETH and its derivative. It's a really stark reminder that even large, sophisticated players, who you'd assume have deep knowledge and resources, face significant challenges. They face the potential for substantial losses, even if unrealized, when participating in these more complex, innovative corners of the crypto market.
So higher yield often comes with higher, sometimes hidden complexity and risk.
That's the takeaway. It demands thorough due diligence and a really nuanced understanding of the protocol mechanics involved. You can't just chase the yield blindly.
Okay, that's a very sobering example. Now, in another interesting, though maybe seemingly unrelated case, we have the prominent Tron founder, Justin Sun. He recently filed a lawsuit seeking a restraining order against Bloomberg. The issue was allegedly inaccurate postings about his billionaire net worth. Now, on the surface, this might just look like a personal legal spat, maybe a bit of crypto celebrity drama, far removed from indicators of an altcoin season. But, in crypto, sometimes these tangential events carry deeper implications, don't they?
They really can. And while it seems distinct from direct quantifiable market analysis, this incident actually draws significant attention to the powerful, often underestimated role of what we could call viral founder dynamics and market narrative shaping within the crypto space.
Viral founder dynamics. Okay.
Yeah. In a market that's still relatively young, rapidly evolving, and often very personality-driven, the public image, the reputation, even the perceived wealth of prominent figures like Justin Sun can significantly influence market sentiment. And by extension, it can influence the valuations of the projects they're associated with, like Tron, TRX in this case.
So the founder's reputation directly impacts the coin's price.
It often can, yes.
Yeah.
When a well-known founder gets embroiled in a public dispute or their financial standing is questioned by major publications like Bloomberg, it can create ripples of uncertainty, maybe doubt, across the ecosystem. This can directly affect investor confidence, not just in their specific projects, but sometimes even in the broader market for similar types of assets. This case really underscores how narratives, even ones stemming from personal disputes, legal battles, or media portrayals, can profoundly impact market perception.
So for investors, this is like narrative risk or
Mhm.
reputational risk.
Exactly. That's a great way to put it. It's a reminder that not all risks in crypto are purely technical or economic or easily quantifiable. Some are deeply rooted in human behavior, public perception, the power of media narratives. In this highly interconnected, often sentiment-driven world of crypto, where information spreads like wildfire and investor psychology plays a huge role, these non-quantifiable elements can have very real financial consequences for digital assets and the market overall. It highlights that understanding the sort of social layer of crypto is arguably just as important as understanding the technical or economic layers. Synthesizing the data and looking ahead.
Okay, we've covered a lot of ground. We've talked about numbers, specific indicators like the Altcoin Season Index and Bitcoin dominance, huge macroeconomic shifts like that $7 trillion, Ethereum's central role, and importantly, these cautionary tales like SharpLink and the just-in-sun narrative risk. Let's try to pull it all together now. It's one thing to hear these individual pieces of data, but it's another to really see how they fit into the bigger, evolving picture of this potential altcoin season. What story do all these diverse elements tell us when we weave them together?
That's the crucial step, isn't it? Synthesizing it all. And to truly grasp the situation, to appreciate the potential trajectory, visualizing these interconnected metrics is absolutely key. So imagine charting that altcoin season index. You'd see it climbing steadily, maybe from around 25 up past 40. Not yet at that 75% full-scale mark Coinbase defined, but undeniably on a strong upward trend. It indicates that building momentum.
Okay, got the climbing index.
Right. Now overlay this with Ethereum's price movement. Picture it inching closer, maybe testing resistance levels, moving towards that ambitious $6,000 target we discussed, fueled by that growing utility and, crucially, the institutional interest.
Ethereum rising alongside the index.
Exactly. Then visualize Bitcoin's dominance chart. See it falling consistently from its recent peak, around 65% maybe, down towards that 59% level or even lower. This isn't just a number. It powerfully illustrates that capital redistribution we talked about. It shows a larger slice of the total crypto market pie being systematically claimed by altcoins.
Capital flowing out of Bitcoin into alts. Check.
Next, picture that monumental $7 trillion sitting in U.S. money market funds, this vast, untapped reservoir of traditional capital, currently earning very little. Now, superimpose onto that the potential triggers for a major infusion. Things like those anticipated Federal Reserve rate cuts, which would effectively push those funds to seek higher returns elsewhere, potentially flowing into riskier assets, including crypto.
The potential floodgates opening.
Could be. And finally, consider the data showcasing that consistent institutional accumulation of ETH. Maybe you visualize it through treasury reports we hear about, or increased participation in staking protocols, or the growth of real-world asset platforms being built on Ethereum. But then, juxtapose that positive trend with the vivid cautionary tale of SharpLink Gaming's significant ETH holdings and their Q2 impairment from the complexities of liquid staking.
The opportunity and the risk side by side.
Precisely. These diverse yet interconnected data points, when viewed together, they tell a powerful, evolving story of market evolution. They paint a picture of building momentum, significant traditional capital poised perhaps for deployment, and Ethereum's central foundational role. But it's all underscored by that crucial reminder. Even the most promising opportunities come with inherent, often complex risks that demand careful, informed navigation. It's a holistic view of a market really in flux, driven by both fundamental shifts within crypto and these powerful external economic pressures. Outro.
So wrapping this all up, what does this all mean for you, the listener, trying to navigate these incredibly dynamic markets? We've certainly seen compelling arguments, particularly from Coinbase, suggesting a looming full-scale altcoin season could be on the horizon. It seems anchored by significant macro tailwinds like that potential $7 trillion waiting on the sidelines and that clear, demonstrable shift we're seeing in Bitcoin dominance. And Ethereum, well, with its growing institutional adoption and its robust, expanding ecosystem, DeFi, stablecoins, real-world assets, it appears to be undeniably right at the heart of this potential surge.
Ultimately, though, knowledge is most valuable when it's understood and applied correctly. While all these indicators might suggest exciting possibilities for altcoins and the potential for significant capital inflows is certainly there, as that SharpLink case so vividly reminds us, there are always inherent risks, sometimes complex risks, things to really consider carefully. Critical thinking is absolutely essential, especially in today's world of information overload. Understanding not just the what, but the why behind these trends, that's what empowers you to make more informed decisions. Decisions tailored to your own risk tolerance, your own investment philosophy, Every data point, every prediction, every cautionary tale we've discussed today is really a crucial piece of the puzzle for putting together your own personal market calculus.
And speaking of putting things together, if you found this breakdown helpful, if you found it insightful, and if you appreciate us diving deep into these complex topics week after week, please do us a huge favor. Hit that subscribe button if you haven't already, give this video a like, and definitely leave a comment below with your thoughts. What do you think about altcoin season?
Yeah, we'd love to hear your perspective.
Your engagement, honestly, it really helps support the channel. It boosts our visibility in the algorithm, lets the platforms know you value this kind of content, and that lets us keep delivering these kinds of deep dive insights for you. So with those potential rewards and those inherent risks laid out, what's your personal calculus for engaging with altcoins right now? Are you feeling bullish, maybe piling in, or are you perhaps waiting for more confirmation, maybe that 75% metric? And thinking longer term, what kind of impact might this potential influx of traditional finance capital have on the very nature of crypto markets in the long run, beyond just price volatility? We encourage you to ponder those questions as you continue your own deep dive. Thank you so much for joining us for this in-depth exploration today.